Hello everyone, I am Najmus sahar, lecturer in business studies, Vishwamana PU College, Chitradurga. So dear student, in previous video we have discussed about one more services of business is insurance. As you all know about insurance, okay, we have seen in last videos, okay, the functions, principles and types of insurance. Okay, in this video we are going to discuss in detail regarding the types of insurance. As you all aware that the insurance company is offering different types of insurance policies. Okay, they are offering different product, okay, different insurance product due to the influences of a companies or due to the influences of a legal enactment which is controlling our insurance business, and even due to the influence of or due to the requirement of an individual, due to the different needs of an individual, the insurance company is offering different types of insurance policies. Okay, so this insurance policy has been broadly categorized into two ways. One is life insurance, another one is general insurance. Okay, so in case of general insurance, again we have different categories like fire insurance, marine insurance, fire insurance, and other insurance like crop insurance, cattle insurance, vehicle insurance, property insurance. There are different types of insurance are there, but as for your syllabus we have only two category, that is life insurance as well as the general insurance. Okay, in general insurance particularly we are going to discuss about the marine insurance as well as a fire insurance. Okay, now let us discuss in detail about the life insurance. What exactly the life insurance is? Since you are all you know that life is a full of uncertainty, life itself is a uncertain. Okay, all the individual try to assure themselves of a certain of some amount. Okay, all individual try to save certain amount for their future contingencies in order to take care their unforeseen events. Okay, in order to take care their future unknown happenings. Okay, they want to secure themselves, secure their life from the future contingents. Okay, individual in the course of their lives always exposed to the number of risk, number of problem. Okay, as we are the individual, we are exposed. Okay, we are facing number of difficulties, number of problems in forthcoming days. That problem, it may be a death of a person, it may be a growing old, it may be a disability, it may be increasing the expectations of individual. There may be number of problems, number of risk we are facing. Okay, a life insurance policy was introduced as a protection against the uncertainty of life. Okay, it is a this policy, usually life insurance policy is introduced in order to protect the human beings from the uncertain events. Okay, protect our life from uncertain events or contingencies. Okay, but gradually the scope of life insurance has been widened. Okay, it has been increased. Okay, the demand for the life insurance has policy has been increased. There are various types of insurance policies available in order to meet the requirements of an individual. For example, we can say health insurance, medical insurance, disability insurance, okay, life insurance. Like this, there are different types of policies have been introduced in order to meet the requirement of individual. Okay, in order to suit the requirements of a individual. As we know that we are exposed to number of risk. Okay, so now let us see what exactly the life insurance is. So meaning of life insurance. So here is the meaning of life insurance. It is a contract where an insurance company undertakes in consideration of regular payment of premium to pay a certain sum of money to assured on the maturity or death whichever is earlier. Now let me tell you about assured and assurer. So assured is nothing but the person or the individual. Assurer is nothing but the insurance company. Okay, as we seen in the beginning itself, insurer and insured. Okay, likewise in life insurance we say assured. Assured is nothing but the person. Assurer is nothing but a life insurance company. Okay, so it is a contract. It is an agreement between two parties. That is, the parties are nothing but the individual as well as the insurance company. So it is a contract, it is an agreement where an insurance company, that is the assurer, okay, insurance company undertakes in consideration of, okay, he makes an agreement uh, by considering regular payment of premium, okay, by considering the payment of premium from the side of assured, that is from the side of individual, and to pay certain sum of money to assured, okay, by the consideration, by certain premium, he will make a contract, okay, I'm going to pay you as insurance company, I will pay you, I'll make a payment to you, okay, that is the sum of money to the assured on the maturity, okay, after the completion of certain years, after completion of certain period, or the death, okay, after anything, any uncertain happen, okay, if any these two happens, okay, whichever is earlier, I'm going to give you certain sum of money, that is called as a agreement which is made by the insured and as well as the assured, okay. As you know that life insurance, life is a full of uncertain, okay, in order to avoid certain risk, life insurance policy they are going to open. So under this, the insurance company undertakes to insure the life of a person in exchange of sum of money called premium, okay. This premium amount, okay, this regular payment maybe maybe in a lump sum amount, okay, at a time you can pay, or you can pay periodically, that is monthly wise you can pay, quarterly you pay, half yearly or yearly, however you wish you can make a payment, okay, premium will individual is going to make. At the same time, the company promise, that is the insurance company will promise to pay certain sum of amount, okay. The insurance company, he will make a promise, that he gives a guarantee that they are going to pay a certain sum of money either on the death of a person, okay, that is either on the death of an individual, or at the attaining certain age, or that is what, at the time of maturity, after completion of certain age, after completion of certain period, you are going to get your assured amount, that is called as a life insurance, okay. Thus the person is sure, here the person is sure that he is going to get certain fixed amount, okay, at the fixed amount he is going to get after the completion of certain period, or either the death of a particular person. At the time of death, his dependent, his legal heirs will get the policy amount, okay. So it is this agreement or a contract which contains the detailed terms and condition, which is put in written, that will be in a written agreement, okay. Such document is called as a policy. So the agreement or the contract wherein the terms and condition will be mentioned, okay, that will be in a written form, that particular agreement or that particular contract will be called as a called as a policy, okay. Here the person whose life is secured, whose life is insured, is called as a insured, okay, is called as a assured, okay. The person is called as a assured, and the company is called as a assurer, okay. So here whatever the amount you pay regular basis, or a quarterly basis, or monthly basis, whatever amount you pay, certain sum of amount what you are going to pay is called as a premium, okay. This life insurance policy provide you a protection to your family in case of premature death, or in case of old age, okay. It may be, it is this particular amount is useful when a elder in a family is died, that in such case that amount will be given to the legal heirs, or if any individual that is the head of the family attains a particular age, okay, if he grow old, in that case his earning capacity will be reduced and the earning will also reduce. In such case this particular amount will be useful. That is nothing but this life protection, okay. Life insurance policy is a protection which your protection, or you can say it is a sort of investment, because it assures, this life insurance policy will assure a certain sum of amount in a particular period, you are going to get this much of amount, that is what the guarantee it is going to provide. So this life insurance policy is also a mode, it is also a avenues for the investment, okay. It is also a avenues, or it is also an opportunity for individual to invest in a insurance policy. It encourages individual to save certain sum of money, okay. out of certain amount you are going to save, that is in the form of premium you are going to pay. This is the thing, but it encourages the savings habit among the individual. That amount it will be useful in a future days. That is what a life insurance policy. There is general rule, okay, there is a general principles that will be adopted in case of life insurance. That principles are nothing but contract must have all essentials of a valid contract. So this life insurance agreement or the life insurance contracts must have all the essentials of a valid contract. When a particular contract will be called as a valid contract, okay, when there is a element like offer and expectance, okay, one should offer, other should accept it, okay, that should be there. Free consent will be there, nobody should force to make an agreement, okay. Consent will be there, okay. Capacity to enter into the contract, it should be a lawful consideration. If all this will be present in a particular contract, that particular contract will be called as a valid contract, okay. That should be there. Next one is principle of utmost faith, that we have discussed in a principles of insurance itself. Utmost good faith is nothing but both should believe on each other, both the parties to the contract should have a mutual faith, mutual understanding, and both the parties should give the correct information. In case if insurance company does not ask about the information, also in such case also insured, that is assured, has to give a right, accurate and material information about his health, about his any disabilities is there, he need to disclose all the information correctly, okay. That is what utmost good faith. Next one is insurable interest, one should have an interest on the subject matter, that is what insurable interest should be there. And the principles of indemnity is not applicable. So here the indemnity principle will be not applicable, as I told you in the beginning itself, in earlier videos itself, that this particular principle applicable only to the fire insurance as well as the marine insurance, but it is not applicable fire insurance as well as marine insurance, but it is not applicable to the life insurance. That is what principles of indemnity. As you know that this particular principle says that, so here whatever the loss you will suffer, this particular principle will says that you are going to get, okay, the loss will be measured based upon the value, okay, based upon the money. Monetary terms will be used in order to measure the loss, but we cannot measure the loss of an individual, okay, person. If we lost any individual in our life, if any person in our family dies, we cannot measure that value of an individual. Likewise, likely this particular principle is not applicable to the life insurance. So now let us discuss about the types of life insurance policies, okay. As you know that the different people have a different requirements, and therefore the insurance company will offer different types of policy in order to fulfill the needs and requirements of individual, okay. And in order to fulfill the people's requirements and their families needs, okay, they offer the different types of insurance policies. Now let us discuss the first type of insurance policy is whole life policy, whole life insurance policy. So in this type, okay, under this type of policy, the amount payable to the insured will not be paid before the death of a assured, okay. So here whole life policy means what? Here whatever the premium you paid, whatever the policy you have made, okay, whatever the agreement you have entered with the insurance company, that amount will be paid only after the death of a person, okay. Only after the death of person you are going to get the amount, but not before the death of a person, okay. After the death of a person, the whole sum, the policy amount will be given to the legal heirs of a family, okay. Whatever the sum then becomes payable only to the beneficiaries or to the legal heirs of a deceased person. Deceased person is the nothing but the dead person. Say for example, A A is a head of a family. Okay, okay, he has his wife B, okay, and his son C and D. C and D. So he has made a agreement with the life insurance policy. Okay, he has of the policy of whole life policy. Okay, after paying certain sum premium amount, he died. Okay, A died. Okay, the policy amount will be given, the sum of amount will be given to the remaining person of a deceased person. Okay, but that amount will be not given before the expiry of a. If he die, then only he will get. If he doesn't die, the amount he is not going to get. Before the death of a person, they are not going to pay. Only after the death of a person, the premium amount, sorry, the sum assured, okay, the policy amount will be given to the legal heirs of a deceased person. So here the premium will be payable for a fixed periods, like for example 30 years, 20 years. Likewise they are going to pay for whole life. Whole life is assured. If the premium is payable for a fixed period, the policy will be continued till the death of a assured. Okay, this particular policy will be continued till the death of a assured. Assured is nothing but till the death of a person. That is what a whole life policy. Next one is endowment policy. Now let us discuss the second type of policy is endowment life policy. So endowment life policy is a in this type of policy, amount is payable only after attaining a specific age or in his death, whichever is earlier. So here the insurance company undertakes to pay the specific sum of amount, okay, sum of consideration when the insured attains a particular age. Okay, here the insurance company is going to pay a specific sum of amount to the person or to the insured or to the assured only after the completion of certain age, only after the completion of certain year or on his death. Okay, whichever is earlier, they are going to make a payment. Okay, okay, the sum is payable to his legal heirs in case of death. Okay, in case of death, the policy amount will be paid to the legal heirs or the nominee which is mentioned in the agreement. Okay, so here the amount will be paid to the assured after the fixed period, after the completion of certain age, certain year, the amount will be paid. Okay, she or he, okay, he or she, until he attains a particular age. Say for example, for the 18 years I'm going to make a deposit, I'm going to make a policy. After completion of 18 years I'm going to get the amount. In between, if I die at the age of 17, in that case the policy amount will be the policy amount will be given to the nominees which is mentioned in the agreement. Okay, if in case if I attain the age of 18, that the policy amount I'm going to get. That is what endowment life assurance policy. Next one is joint life policy. This policy is taken up by two or more person jointly, and even here premium will also paid jointly. So usually this type of policy, under this type of policy, as I told you, this is taken by the two or more person, and they are going to pay a premium, that is sum of amount, to the company jointly. Okay, they may pay in a lump sum or they may give in a installment basis. Okay, so upon the death of any person, okay, if any person dies, okay, then the survival, the other member is going to get the policy amount. Okay, this particular policy will be taken by the husband and wife, and usually the partnership form. Okay, the partnership form, they are going to opt this type of policy. Next one is annuity policy. So annuity policy. Under this policy, money, that is the assured sum or the guaranteed amount or sum of amount or the money, policy money is payable to the assured after attaining a certain age. After attaining a particular age, the assured, that is the individual, he is going to get some money from the insurance company in monthly basis, in a quarterly basis, or any of this form. He is going to get the amount, he is going to get the policy amount from the insurance company. after he attains certain age. Okay, even the premium also paid by the individual to the insurance company, he may made in a lump sum amount in at a time he can pay, that is what we say single premium he can made, or even he paid the premium in a installment basis over a certain period. Okay, likewise installment basis premium, and even you can get the amount from the company in a monthly basis or quarterly basis, whichever you have stated in your agreement. This particular annuity policy is suitable for those person who wants regular income, who prefer for the regular income after certain age. If they want any regular income, they will prefer this particular type of policy. Usually the old age person or the retired persons, they are prefer for this policy. Next is the children's endowment policy. This policy is taken by a person for his or her children to meet the expenses of their education or marriage. Usually this type of particular policy will be adopted by the parents for their kids, for their children, to meet the expenses of their higher education or their for marriage. So under this policy, under their agreement, the contract will state clearly that the insurance company is going to pay a certain amount only after his or her children attains a particular age. Okay, after attaining that age, they are going to get the policy amount. Okay, here also the insured, that is what the person, he is going to make a premium. Okay, premium is paid by a person entering into the contract. Okay, however no premium will be paid if he dies before the maturity of the policy. If he person dies before the maturity of the policy, or the children is going to die before the maturity of policy, they are not this means the insured is not going to pay the premium for the policy. This is what the 5 types of life insurance. Next is fire insurance. As you know that we have two categories of life insurance. Okay, one is the life, another one is the general. In general, again we have fire insurance as well as the marine insurance. In that we will discuss fire insurance. So fire insurance is a contract. Fire insurance contract is a contract by which the insurer undertakes in exchange of consideration, that is premium, to compensate the insured against the loss by fire during a particular period or up to an agreed value. So here also it is an agreement wherein the insurance company, for in return of consideration, in return of premium, the company is ready to compensate the loss which is faced by the person, okay, due to the fire during a particular period or any up to the agreed value, up to the certain value. If any insurance company agreed to pay in return of consideration, in return of premium, the company is going to compensate the losses which is happened by the fire. Due to fire any losses happened, then the insurance company is ready to pay a certain amount, okay, to fulfill the losses. Okay, so here this fire insurance policy will be lost for 1 year. Okay, it will be lost only for the 1 year. After completion of the 1 year, again the same policy have to be renewed. Okay, again that particular policy has to be renewed. Okay, it will be lost only for the 1 year. Here also the premium amount, whatever the premium amount a person is going to pay, he can pay that premium amount in installment basis, or he may pay he may pay the premium amount on a lump sum basis. Okay, so here the claim for the losses by the fire, if you suffer losses, you want to claim the insurance company to cover your loss. Okay, you can the claim of a fire insurance can be satisfied in a two conditions. There must be an actual loss. Okay, actual loss should be there, and the fire must be accidental but not intentional. Okay, there should be a accidental losses, accident should be happened, and there should be a non-intentional. It's okay, intentionally wise you should not do that, the loss should suffer only on unintentional basis. Okay, the risk covered by the fire insurance contract is the loss resulting from the fire or some other causes. Okay, it may be you may suffer the losses from the fire, or maybe other causes will be included, but here fire insurance company, what they will do, they are going to find out the proximate causes, okay, that the principles of the principle which they are going to follow will be there here. One is the utmost good faith, insurable interest, and indemnity. Indemnity means what? How much loss you have suffered, that much amount they are going to pay. What is the market value of that particular product? Okay, they will measure the price of a product, the loss in a monetary terms. They will measure the loss in a monetary terms, and again they are going to make a payment. Next one is proximate cost principle. They will follow. This particular fire insurance contract will be based on certain fundamental principles like the principle of proximate cost, the principle of indemnity. They are going to follow. Proximate cost means what? Which is nearest to cause, which is a direct cause for the losses, that they are going to find out. Okay, after find outing that, they are going to satisfy your claims. Claims will be satisfied when the condition is satisfied. Conditions, what are those conditions? There must be a actual losses, loss should be happen, and the fire must be accidental. Okay, the loss of goods should be through the fire, and that should be a non-intentionally. Okay, that should be a accidental but not incidental. Okay, that not intentionally you have made, then only you are going to get the amount from the insurance company. These are the fire insurance as well as the life insurance. Next we are going to discuss about marine insurance in a next video. Okay, thank you.